Happy Friday, everybody. How's it going?
It's going well. Welcome, Natty.
Thank you. Good to be here.
Yeah, Natty, what's up? It's good to see you again. So if people don't know who you are, do you want to give a quick intro?
Yeah, sure. So I have a real name. It's John, but everybody calls me Natty, so you should definitely feel free. I lead solutions architecture for one of the regions over here at DBT Labs. But I've been in the data space for a long time, have kind of been a serial startupper throughout my career. Yeah, I happen to be really interested in kind of equity compensation stuff, which is kind of a function of the fact that I've always done startup stuff. But yeah, it's been a fun ride, kind of seeing the rise and fall of Hadoop and the rise of the modern data stack and cloud data warehouses and all of the stock stuff that comes with it.
That's really interesting. I mean, we met several months ago, and I was very intrigued because I thought that because we were introduced to a mutual friend, and I thought we'd be talking about tech stuff, right? But then then I realized you had a blog, and I looked at your blog. And I was like, this is very unusual. You have actually, I'll share it for the audience here, but your blog, it's all about equity and startup stuff, and it's kind of interesting. So yeah, walk us through that. What's up with Semistructured?
It's like I think basically my sort of thesis has been that there are a lot of people who for whom their compensation packages are really heavy on the equity side. But I think a lot of these things, a lot of how to think about that equity, how to like decide whether or not to exercise your stock there's not a lot of education on it, right? A lot of companies don't provide that information because they don't want to be seen as financial advisors or giving financial advice, right? They can't. And so a lot of this information is just kind of hard to find. And I've never seen anything that was like super readable. So, at some point I was just, actually what happened was I had my first post was something that I'd written probably like months and months and months before, and just hadn't gotten the like courage to put it out in the world. And eventually I just said, screw it, like I'm gonna go do it. And I put it up and it resonated. And so I've kind of kept writing and just been talking about the things that I think people should know about and what interests me.
Yeah, and it's interesting to look at the space. I think notoriously, in the case of WeWork, there were allegations that maybe employees were a bit misled about equity, not just because of the issue of legal advice, but just to not really tell them how much they were getting compensated and how much they stood to lose if things kind of went down. So I think they're rather magnanimous startup founders who really do care about their employees and take care of them, and who are careful to try to explain those things the best they can. But I think there are other shenanigans too. What's your opinion on this show?
Yeah, totally. And I mean, we're like, at the end of the day, like when you're recruiting someone, you have to sell them. And so, there's definitely, I think, a lot of sort of veiled information that gets shared out. I think, every company is different, right? Like I actually think DBT Labs is pretty good about being very open and honest. And we've got, a strong culture of transparency. So I'm really happy with the kind of information that goes out to folks in my org. But I've definitely seen companies where it's like, I have to like, ask and ask and ask just to find out what the strike price is. Like they're really skittish about sharing that kind of information. And it's unfair to the employees, right? It's something that they need to know to really adequately evaluate the worth of their stock and their compensation, and think about critically, like, is this actually going to be worth what you're telling me it's going to be worth? Or like, do I think you're spewing a little bit of BS, right?
Well, let's walk through this. So, I mean, what are some of the things that people should know when they join a startup with respect to equity? I think, to your point, when you started your blog, it's like it's kind of a black box, really, and there's not a lot out there. So,
I feel like the most important thing, probably the most important thing I could say in a single sentence is like the number of options doesn't matter at all, right? Like the thing that actually matters is percentage ownership and how, like, what the value of that equity is today and what it could be down the road. And so I think like there's a bunch of like particular pieces of equity packages that are often not like people don't necessarily know to ask for. Like what is the fair market value today, which that's equivalent to the strike price. Those things end up being the same generally. But fair market values typically change when fundraising rounds happen. And it really determines like the price for your shares when you go to exercise. Also, what was the preferred price in the latest round? That's what the investors are paying. So oftentimes the strike price is lower than the preferred price, and that's kind of that implicit value that people get when they come on board. So like that those fundamentals, those are really the most important bits. And that's, if you look in my on my Substack, you'll find the oldest posts are really that, because I was like, this is what everybody needs to know. So like, let me write this first. Yeah.
That's pretty cool. Let me actually show that real quick here.
Most of the posts are decent, but I think the earlier ones, like it kind of goes. There's sort of this like foundational, like, okay, let me talk about the foundations of this stuff, and as I got a bunch of those things off of my chest, the later stuff starts to get into like nichier topics in various cases. But it's just like I try to write approachable content, and when possible, I try to like talk about it in terms of like how I think through these questions, just to make it a little bit relatable, so people can pick it up and make their own decisions using.
Well, that's the thing too. Like VCs are doing this every day, right? I mean, this is how they think. This is what they do. I mean, I think when I got into studying venture, it was the best book I found. The first good book I found was Venture Deals by Brad Feld. That was back at like 2010 or something like that. I can't remember, but anyway, it was a while ago, right? And I think there were a few blogs at the time. Fred Wilson had some good stuff. This Week in Startups, I think Jason Calacanis' podcast was fantastic for somewhat opening the veil on how VCs may operate. But at the same time, it was like finding a lot of getting educated on how to think about startup equity, because I was joining startups at the time too. And I was like, so how does this work? And it was mysterious. I guess it still is for a lot of people, which is because a lot of it's in finance speak, and engineers and startup salespeople don't really speak that language or think that way. So it's hard.
And one thing that's really important to just call out here is that VCs think about, equity a lot different than employees should, right? Because like at the end of the day, the VCs are investing out of a fund, and that fund has, dozens, hundreds of investments, probably in some of these larger funds. A16 raised that $400 million seed fund, right? Seed checks are small. So $400 million divided by, a $10 million, $20 million seed check, which is, they didn't used to be that large. They used to be a lot smaller. So like you're talking about like dozens and dozens to hundreds of investments. And so when they're evaluating an investment, they're really thinking about it a little bit differently than an employee who's investing the most valuable thing that they can invest, which is their own time and energy into that company. And it's the difference between saying like, I need one of these 100 investments to hit a home run, versus like, this is the one that I need to hit, right? So it's a much different equation. I think VCs are often thinking about like, how do I get a 3x return, right? And there's actually there is a blog post that I saw, and I forget who wrote it. It is a VC, which was actually one of the best ways that I've seen to really think about a particular startup success, and it uses this like weighted value outcomes approach, where basically it is a statistical expected value equation, right? It's like what is the likelihood that this company goes out of business and goes to zero? What is the likelihood that this company is successful, achieves a modicum of success, they go for $100 million exit, whatever? What is the likelihood that this company is going to be a category defining winner, right? And this is like a 10 plus X outcome. And so they actually think about it as like, what are the likelihood of each of those outcomes, and at what would they make with a particular size investment in each of those outcomes, and then whatever the expected value of that is, that's how they're thinking about the potential value of this equity. But again, as an employee, I don't get all those shots on goal. So, I'm looking for which one is going to give me, which one has the highest likelihood of that home run. But like when I'm looking at an offer, I want to use that sort of approach to evaluate how valuable do I think this equity really is.
Let me ask you another question here too. So two different questions actually. So first of all, if I'm looking to join a startup, how should I evaluate that decision? Because like you said, it's a huge investment of time, like a lot of energy in my life. And then second, how should I evaluate if it's time to leave? Like when do I say, hey, it's time to jump now? Because I don't think this is going to pay off and I'm just wasting my time.
Good warm-up questions, Matt.
Yeah. We're just going to dive right in.
Those are tough ones. Well, I mean, if it's DBT Labs that you're evaluating, the answer is just yes. So just join.
We're going to join tomorrow.
But that aside, the leave question honestly is a lot harder. I've I will admit that I left my last company after a year, which is not great, but I was sort of at this place where I really wanted to go to DBT, and so I knew I was gonna make that move. But I wasn't willing to leave before my 1-year cliff because I felt really strongly about that, that company also being successful. And so I wanted to make sure that I had that opportunity to exercise some of that stock and walk away with something, some investment to hold. But I think, it's I don't know that I ever make decisions to leave a company based on compensation, right? Like I can get, good equity comp or good salary comp, at a lot of different companies. I leave a company because I'm not growing. I'm not, it's the intangibles, I think, excitement levels, things like that. Certainly when I'm evaluating companies to go to, those are also big factors. Am I excited about this product? Am I excited about this team? Am I excited about the space? I've been in the data space for, it's been, I don't know, 13, 14, actually my 15-year college reunion is next year. So it's been almost 15 years since I've been in industry. And I've basically been in the data space for all of those 15 years, because it's what I'm really passionate about. Even though I have all these interests in finance, and probably I was an accountant in another life, I just really, really love data. I really love a lot of what comes with it. And so I'm always looking in that space. And then oftentimes, when I think about things that I'm excited about, I've always liked early stages. So from a perspective of the stages I've worked at in my career, the kind of median has been B/C round. That's been the most common point where I've joined a company. But I've done pre-seed, seed, pre-seed. I've done A. I've done, I've been at companies at D and beyond. But what I like is that at the B and C round, the company is large enough. It's usually in the last couple of years, things have been a little bit crazy, but over my career in general, B and C is sort of around 50 to 150 employees. Probably somewhere in the range of 1 to 10 million in ARR. And it's early enough that I still feel like I can make a big impact. But it's far enough along that I feel like I can effectively evaluate how real is, their solution, and how likely is it to be kind of a standout success. So that's a long-winded way of describing some of the thought process for me.
That's interesting. Yeah, and it's interesting too. So it kind of, I guess, good question, Matt. Segues us into the topic of today, the Great Startup Downturn of 2022. So it seemed like we started the year, things seemed, it is what it is. 2021, in retrospect, was kind of a bonkers year. That was just, in my opinion, it was sort of like the year that, of anti-gravity, basically. Everything was just free floating, and who knew which way it was up or down. But This year's different. What are your thoughts on what's happening in the startup ecosystem right now?
I feel like the term of art these days is just multiple contraction. I feel like everywhere, it's just VCs and finance people talking about multiple contraction. Jamin Ball from Altimeter writes an absolutely fantastic Substack called Clouded Judgment, where he talks about a lot of these dynamics in the SaaS marketplace. And some of it goes over my head, but I try to read it to educate myself. And I think it's interesting. Like late last year, Tomas from Redpoint was talking about the 100x forward ARR multiple being like the standard way that companies were being valued, which is like a really, really, like, that is a big multiple. And maybe to back up in case folks aren't familiar with like some of these terms, like when I talk
let's
about
go over these terms
multiple,
real quick. Yep.
I'm talking about like a fairly common way that you do a kind of a crude valuation of a company is you look at either their trailing 12 months earnings or their forecasted next 12 months earnings, and then you apply a multiplier. You say, if you're going to make $10 million this year, and I'm going to apply a 10x or a 20x multiplier, then you should be worth $200 million, right? Like that would be that 20x multiple. And like, I think historically folks had valued more on like what you'd achieved. And in 2021, people were like, well, the price, like, there's so much free flowing money around there, interest rates are so low, and we've got so much so many funds to deploy. People were like, well, price competition got heavy, and they started shifting towards looking at like, what are you expecting to do, which is like dangerous, because you might not achieve that, right? You might overpay for something that doesn't actually live up to your potential. But that's kind of the risk that you had to take in, the kind of late 2020 or 2021 market. Yeah. And now with inflation kind of going haywire, with the Fed jacking up rates, and I've been watching this because they've been talking about, they've been kind of indicating that in the July Fed meeting they might raise the rates another 75 basis points. And like, personally, I've got a bunch of CDs that have come due, and I'm like waiting till they raise rates again to go and redeploy my emergency fund.
For the audience that has only lived in low interest rate environments, what is a CD?
A certificate of deposit, just like, like, this is where I keep my emergency fund. It's just like, savings accounts have like interest rates, and that
back in the day, you could get paid by putting your money in a bank. It's a weird concept, but trust us, it used to happen. Yeah. So.
Yeah. We just put it in there for who knows why.
Get paid for the deposits that the bank lends out. But yeah, so like, I mean, with interest rates going up, right, it creates an environment where it costs more to borrow money, which means, the cost of money to invest gets higher, right? There's fewer LPs that want to invest that capital, or they want to be more judicious, because it's not like they're just going to be able to go back to the well again and again and again, as it's been for kind of the last 10 years. And so people are looking harder at their investments, which is, causing the markets to become shrewder, to take money out of like the really speculative bets and just pile it into, safety, low risk type of things.
Well, sure. And I remember it was an All In podcast a couple months ago, but Chamath had a interesting tidbit where he said it was like, for every 100 basis point increase in rates, it was like you can basically shave off 15 to 20%, off evaluation, just mark it down. There you go. So, I mean, you don't need to do the math that hard to figure out like, 100, 200, 300 basis point jump in rates, what it does evaluations. If you raise the top, it's going to be kind of hard. We'll get to, in a second, to down rounds, because you wrote an awesome article on this, but sobering. So,
yeah, and it's I think the investment markets are going to be tough. Like, I've talked to organizations that were going to raise money and just decided, now is not the right time. Like, there's a lot of organizations that are just kind of hunkering down, extending runways. And that's why we're seeing a lot of these layoffs happen, because like, oh, it turns out when you turn off the spigot of like cheap capital, suddenly we have to, everybody starts looking at like unit economics, and we have to get a lot more focused on making sure that we're building profitable, sustainable businesses instead of just like spending funny money.
It's a truly radical concept. I think we've all forgotten that in the last decade.
But what happened though? I mean, because we've seen this before, right? I mean, the dot-com bubble, you had this, other periods of speculative excess, and it's like when the money's free flowing, what is it that prompts, I would say, both investors and entrepreneurs to sort of forego what we would normally consider basics, like running a business, unit economics, revenue, profit, things like that?
Yeah, it's a good question. I mean, I can opine and
opine away, please.
Like, I have never been a CEO of a company. I've also never been a VC. So like anything I say is like, sort of speculative in and of itself. I just think a lot about, some of these dynamics, but like, I think part of it is just, it's harder to take a long-termist view than it is to, just think about like what's tactically right in front of you today. And so sometimes, it's just easier to think about the here and the now. And if the here and the now, demands spending, and, you perceive that it's easy to get capital, right? Like 6 months ago, or maybe not 6 months ago, but like 12 months ago, certainly, rounds were just being preempted, right? VCs were coming back and they were like, I have more money for you, like take more of my money, right? They just wanted to deploy more. And so like, unless you are like a really laser focused CEO, that probably has a psychological impact where it's like, I've got tons of money, like money's easy to get. And that's, why I think you see like the Sequoias of the world who put out these like, doomsayer types of memos where they're like, hey, everybody, party's over. Like, let's get back to basics. And, smart, forward-thinking CEOs, are probably already thinking about that and are setting themselves up for a good thing, or a good ride. But like, it's also that, the investors will also value things differently, like growth at all costs versus, profitable unit economics. Like if you're getting penalized for being profitable and not growing fast enough, then people are going to go try to spend more money to grow faster, right? And if you're penalized for growing at all costs, but you're being, rewarded for having profitable unit economics, people are going to go do that. And so, I think there's just a pendulum shift to like, what are people being penalized for and what are people being rewarded for? And that, creates this dynamic where you see these, shifts in just how people spend money.
Yeah, it was interesting. We were actually talking to a colleague in private equity today, and we were kind of asking him. So with the cloud and economics in the PE world, like, does it make any sense for us to try and help companies save money over the long term? Maybe they have on-prem, for example. Maybe that makes their EBITDA number look better because they have capex instead of opex. And the interesting thing was, well, I mean, our incentive is we really just want to sell the company at the end of the day. It's not really our problem if it is like a viable long-term company like that. We need to make money for our investors, and that's kind of how that is. And so you're right. It's like incentives and outcomes, right? It's usually what it boils down to. If you have any thoughts on this, Matt?
Yeah. I mean, I think that's absolutely true. Yeah. And there's this other, in PE, you have this incentive with interest deductions, right? Interest tax deductions, which many people have pointed out, where PEs will sometimes use a company as a vehicle just to borrow tons of money just so they can get that interest tax deduction and take the money and put it somewhere else, which is not an issue you have in startups. It's a very different set of incentives, but it can be a very positive thing, or sometimes it can have some deleterious effects on the company, just like you were saying, Natty. So yeah,
that's interesting. I will admit I am way less educated on like PE dynamics.
Yeah.
It's like PE and VC are like very different worlds.
Very different worlds.
Yeah. It's both super interesting.
They both are. Yeah, that's interesting too. I mean, so to maybe just show this article, this is what I pinged you about, and I was like, yeah, we got to talk about this. This is pretty cool. You wrote your recent article, how I'm thinking about down rounds in equity during a downturn by Natty. So yeah, zoom in on this a bit, but yeah, walk me through this. Like, what give us just the article. What do people need to know about down rounds in equity during a downturn? I think this is top of mind for a lot of people.
Yeah, I guess the thing people need to know about down rounds first is they're going to happen.
What's a down round?
So when a company raises funding, at some point, basically, an investor is coming and purchasing stock from that company, and there is a price per share for that stock. And when an investor pays more for the stock than the last time an investor bought stock from the company, that's an up round, right? That's what most people just talk about as fundraising, because in general, these will generally go up. Like, nobody wants to raise at a lower valuation than they previously had. So they're always trying to have, valuation step ups. A down round is the opposite. It's where you raise more money, but it turns out investors don't want to pay the price that your stock used to cost. And so, they pay a lower price. You see the same thing in the regular stock market, right? There's all this jitter on a stock market thing. And, theoretically, like, anytime you're seeing the price go down, it's because someone is saying, like, that price that you've got for that stock, I'm not willing to pay for it at that price. I'll pay at a lower price. And someone either, on the supply side says, yes, I will sell it to you at that price, right? It's all supply and demand. In the private markets, these things just move much slower, right? You have step functions, not like, continuous graphs. And so it's unusual to see down rounds because it's not a good thing. It's not a good look, right? The optics of a down round are bad, right? Oh, your stock price is going down. Like, all of your employees are not making money. They're losing money, right, on their stock. And investors are losing money. And investors, like venture capitalists, the way they stay in business is by making money, not losing money. So everybody wants to go up. But like, now we're getting to a point where I think investors are sobering, and they're starting to say, oh, we need to look for profitable unit economics. And so when companies need more money, they're going back and the investment committees are starting to say, yeah, we're not going to pay that previous price. We're going to offer a lower price. And it is then up to the company to decide, yes, I am willing to sell at that price, or no, I am not. I'm going to continue to kind of stay toe the line. And they have that option, right? They can choose to continue extending your runway. But the tenor of this article is really kind of accepting that down rounds are going to be a thing, and just thinking about, like, what does a down round mean for you in terms of exercising your options, in terms of deciding whether to exercise and not, when to exercise. This is, it's sort of funny. Like, I was writing an article. One of the articles I wrote a little while back in 2021 was about how the current markets are actually really, really dangerous for employees because valuations are going up so fast, so frequently, right? There were companies raising, if you look in the article, I've got a bunch of examples of companies that raised, like, every 6 months they were having like a 2 to 4x step up, which means, like, if you have a standard 4-year vest, then you've got a 1-year vesting cliff. And so by the time you start a year later, there's been, 1 to 2 rounds of funding that have happened since you started. And, now the fair market value of the stock is much higher than, when you started. And so, like, there's tax implications, and it effectively becomes really expensive for employees to actually exercise their options and own their company's stock. But I'd say here, down rounds can be bad. But the nice thing, the thing to really remember, and I like this graphic I put together because I wanted to kind of show, like, it's not always a disaster, right? Like, on the left-hand side, you're seeing a situation where, if you started at a point where the value of your stock or your strike price was low enough that, if there's a down round, you're not necessarily underwater, right? Like, you're not necessarily losing money on your stock. But there are situations where, if the preferred price that investors are paying after a new investment is lower than your strike price, that's like not a great sign.
No, that sucks.
Well, didn't Facebook famously have a down round? Am I remembering this correctly? I think that's an example people cite sometimes of them having a down round.
It's certainly possible. I
Yeah.
mean, it's certain. It's not like so uncommon that you can't find examples at major organizations. It's just like, especially in the last 10 years since kind of the great financial crisis, we've been in this very sustained bull market where we haven't really had to face that. Like, I was definitely the last time I really felt like, oh my God, like we might have a down round, although I didn't really know what I was doing at the time, was my first job out of college. I was working for Vertica. And I graduated college in 2008. So like right before all hell broke loose. And, I just remember like, sitting there and thinking like, oh my God, am I going to get laid off? Is this company going to go under? Like, I had no idea what was going on. And I don't think we took it down round, but it was definitely something that I think was a concern.
Yeah, for sure. I kind of want to talk about this too. This came out from CB Insights today, State of Venture. So it's just as a summary. You can subscribe to CB Insights if you want. But what's interesting is quarter over quarter, venture funding dropped 23%, right?
Mm-hmm.
So, but that sounds drastic until when you kind of zoom out and say, oh well, it's still better than it was in 2020 when things were sort of going crazy and stuff. But
the thing is, funds are still raising like crazy amounts of money. Insight Partners just announced they were raising another 20 billion. I think they announced. This news just came out yesterday, and so it's like there's still a lot of money out there. But like what I see in this is again, the interest rates are rising. People aren't quite sure when inflation is going to be tamed, and so everybody is kind of like risk off.
Yep.
And so you see deals going down because nobody's, there are fewer of these speculative investments being made, but there's still money to invest. And so I think we'll see this flight to safety where like the really, really successful companies continue to have, they probably don't get the crazy valuations, but they have easy money, right?
Yeah. What's also interesting too is, okay, so new unicorns, 85 minted in Q2, right? Get some perspective here. If you go back, it's still more than you were doing in 2018, 19, 20. Mm-hmm. This is when basically zero interest rates hit and bam, but because of the pandemic, and a bunch of money floating into the system. So I think this more shows like, I think you're just gonna probably reset back to probably more sane times, and like the sky is falling. This is, I read an interesting article too in the Wall Street Journal the other day where they said, if we're in a recession, this is definitely a weird recession because like the normal metrics of, job losses and stuff that doesn't seem to be happening.
Unemployment is like at historic lows,
right? And you got the jobs report today, and it was like, yeah, okay, I guess there's a problem, maybe. Mm-hmm. So probably not, but you just don't have enough people to do jobs, I think, is more of the problem right now. So if this is a recession, I'm cool. Like, love it. So,
well, it's interesting too, because if I'm an investor or an employee of a startup, I feel like you have to break the question of a down round into two parts. And so I have to ask myself, okay, how much of that down round is reflecting changes in the economy, maybe a bubble kind of deflating, versus how much of that down round reflects actual problems with the company itself, or maybe they really aren't going to perform well in the future. Now, you can't completely unknot those two, right? Because definitely a bad economy can kill a company. But there's still, you probably have a sense of some of the intrinsic stuff going on and whether this company has a chance to be a category killer, even though the economy is temporarily dropping.
Yeah. And I mean, like, I can only speak from my own personal experience, but like what I can tell you I'm seeing at DBT is like we're firing on all cylinders, right? Like companies are still buying our software, and we are still succeeding by every metric I can look at. And so I agree. It's kind of a weird environment, and like it's even more interesting comparing this to kind of the last time I saw kind of a major downturn. Like at the beginning of the pandemic, I was at Heap Analytics, and we sold to a lot of SMBs and kind of mid-market companies, and it was just like cash flow crises from our customers left and right. Like invoices were not being paid, like just like scary stuff. And I think it's like it's interesting seeing it now. Like, you know, we're definitely seeing some of our customers in the news laying people off or you know, taking down rounds. But at the same time, you know, we've got a really strong sales motion up market as well. Like DBT is being widely adopted in the enterprise as well, where,
Oh, yeah.
you know, they're a bit more recession resistant. And I think like this sort of, you know, for companies like in a down market, I really look for who has strong enterprise traction, right? Because enterprises, they'll shut down projects, they'll slow spending, but like they don't go out of business in general, right? Like, you know, outside of like the Lehman Brothers sorts of situations, the you know, Fortune 500s don't just like shut down overnight and have cash flow crises where they can't pay their you know, pay out their accounts payable, right?
Yeah, it's interesting. You know, we remember the COVID outbreak too, the pandemic. Matt and I were, you know, things were going good, and all of a sudden it's like the floor just dropped out from our customers.
Yeah.
And it's like, oh my gosh, sky's falling, and understandably so, right? It's like,
Yeah.
you know, if you look at any graph of what happened during the pandemic economically, it's like just a vertical line. I remember seeing like the unemployment. I remember actually the you know, a couple weeks after the pandemic, looking at the unemployment, and it was like it was so the graph was so deep, it almost looked like the x-axis, except it was the y-axis had dropped so far that I think they had to like make a different. They had to adjust their boundaries on the graph. It was just so unprecedented. You never saw that much like month over month drop ever. But then things rebounded like real
within
quick.
days.
Within
It seems
days,
like. I
right?
mean, I'd have to go back and look, but it felt like the bottom dropped out, and then like maybe a week or two later, like, oh wait, come back, come help us.
Oh yeah, we're selling more than ever. We need all your
Yeah.
help, and you know, so you know,
I mean, I
whereas
think it depended what industry you were in, right?
yeah,
Like,
if you were in
true.
restaurants or something,
Yeah.
you were like,
and I mean, this is like that K-shaped recovery they talked about,
yeah,
right?
it was
Like,
K-shape, yeah.
you know, in the tech world, like you didn't really feel it. Like,
No.
you know, living in an organization that's selling data products, like it felt kind of like I mean, it was a weird time for other reasons, but like it didn't feel like it was particularly disruptive to business.
No, whereas I know people who owned restaurants, you know, and gyms,
Yeah.
and you know, I know one guy who owns, you know, a lot of restaurants in you know, the city I'm in, and like he said, like, you know, half the restaurants went out of business,
Yep.
you know, and it was bad. And then gyms were the same way. I know a friend who owns you know, a lot of gyms, and that was the same sort of thing. It's like he had to do everything in his power to keep things going, and I felt terrible because that week that the pandemic, the national emergency, he was supposed to open, you know, this brand new multi-million-dollar gym, and then that had to be halted. That sucks.
Yep.
So we're lucky in tech, but you know, nowadays the story is different. Now tech's getting affected, right? And it's like in these industries that we're having trouble finding, you know, staying in business, like they're doing great and can't find employees anymore, and you know, so it's everything's a pendulum, like you say. So
and it's funny how often we ignore these pendulums, right? Once the pendulum is swinging up, like the founders, the engineers are like, we're geniuses, this is amazing, we're all making so much money off of the pandemic. But then as soon as like that started to reverse, like, oh hey, people don't have as much time to watch Netflix, they're canceling their subscriptions. It was just like total panic, like, oh my god, what is happening?
Easy to make money in a bull market.
Well, everyone looks smart in a bull market, right?
Exactly.
I like the downturns for this reason, because it actually forces you to have to operate like a normal business. You know, if you have a giant cash infusion, it's just like taking steroids. Like it'll make you look cool. Or synthol is more what I consider it to be. Not even like steroids. It's just like your, you know, fake muscles, but
your muscles collapse or something, tear your bicep.
What I do think is interesting, and what I've kind of been waiting to see, and I don't think it's started yet, but I think it will, is you know, you showed that chart of kind of like the deals going down, but I think there's going to be, you know, probably a lot of M&A happening over the next year. You know, like certainly any kind of late stage company that's got its coffers full and feels confident enough that, you know, they're going to be able to weather the storm. Like this is a great time to go shopping for cheap acquisitions. So I do expect to see a whole bunch of that. And like that's where kind of like the PE stuff starts getting interesting, because like that's their bread and butter, right? Is buying companies, you know, coming in, making them efficient, and then, you know, selling them off, or, you know, integrating them into other companies. So
Yeah, and there's some great ones too. Like Thoma Bravo, I think is like the epitome of a great, tech-oriented M&A company or PE company. They just do a
yeah,
really
them
good
and
job.
like Vista
Mhm.
does a ton of it, and I think Insight actually does a whole bunch of like I don't know if Insight does acquisition, but
Interesting.
I mean they do a lot of like PE stuff.
Interesting. So if you're an employee at a startup, like what do you do these days?
Stay the course. I don't know. I mean, like I'm so I sort of shared in the blog post what or the newsletter what I'm doing, but I again still feel really strongly that like when I think about those weighted value outcomes that I talked about, like DBT for me is category defining technology, right? That's where I believe we sit. Um, and I've got there's a whole other post called my career investment thesis in DBT, which
Mm.
explains like
Oh
why
yeah,
I
that's a
think
good one.
that. And for anybody in the data ecosystem, I think hopefully it's an interesting read. But because I think that there is a high likelihood that we come out the other side stronger than ever, I'm certainly exercising my equity, right? But what I am doing is being a little bit more cautious. Like I don't foresee us raising anytime soon because we raised back in January or whatever, and it was a pretty 220 million, I think, was how much we raised. But we've got a whole bunch of money in the bank, and so we don't need to raise anytime soon. So I don't feel pressured to go exercise rapidly. So I'm basically getting myself to a point where I'm like I don't want to hit AMT. AMT is like a pain in the butt.
What does that stand for?
Alternative minimum tax. This is
Ah,
like the one part of the tax code that I sort of like. I've never spent enough time to like educate myself really well on it, but basically it's like a flat tax. It was originally designed to be this like rich people tax, right? Like if you made above a certain amount of money, they were like, no, like you don't get to take deductions or whatever. We're just giving you a flat tax, like you just pay that on all of your income. But it's kind of a weird thing because like most people never hit it, they never experience it in their normal course of life. But when you exercise incentive stock options, ISOs, the IRS looks at the difference between the current fair market value and your strike price, and they're like, oh, you just made a whole bunch of money. So like if you have if you've got a $10 fair market value and a $1 strike price, you exercise that, you pay $1 to exercise that option and purchase a share for $1, and the IRS is like, oh, you just made $9, and you're like, well, it's a private company, like I can't sell it. IRS doesn't care. They're like, no, you made $9, like you're on the hook for that. But for incentive stock options, it's a special type of stock option where they don't charge you that income tax right off the bat. What happens is it counts towards AMT. And so basically when you file your taxes, you're like, if you go through an accountant, they calculate both, or like you file through TurboTax, it calculates your normal income and your AMT alongside it. But if your normal income tax burden is greater than AMT, you don't pay any AMT. But if the AMT is greater, you pay that. And so it's one of those things that, when people go to exercise stock, it sometimes catches them by surprise, especially if they work at a company where that stock is highly appreciated, because suddenly they're paying tens of thousands of dollars in taxes on income that they actually can't put in their pockets.
Mhm.
So it's like big pain in the butt. And so where I'm sitting, I'm like, well, because I don't expect the fair market value to go up a ton anytime soon. I'm like, okay, I can slowly exercise this. I'm definitely going to exercise it because I want to have long-term capital gains by the time, I get to sell it. But I don't want to hit AMT along the way. And so that's kind of how I'm treating it. But like, if you go through a down round, like that fair market value goes down, so your AMT exposure goes down. So, it's actually like the best thing you can do in a down market with equity is wait and just like don't do anything. Just wait and see what happens.
So really, what about if your startup offers you a loan to buy stocks right now?
Oh, uh,
Oh, it's visceral.
This is
Do you want a bucket for? Just kidding.
There's an article in Wired from a little while back. Bolt did this, and there were a bunch of people who basically got laid off and suddenly were on the hook for these huge loans because they'd taken money out to purchase to exercise their options, and the market's private, so like they can't just sell their stock and pay it back. And so they're like, am I allowed to use profanity on this thing?
Oh yeah, you are.
They're up shit creek, right? So it's like it's a bad situation. There are a lot of interesting ways that people pay for stock. Like there's a lot, the standard way is you go to your company, or like if you use Carta, you go to Carta, you say, I want to exercise. And then, you give them your bank details, and it's just like an ACH withdrawal. Like you get your stock, right? Loans are definitely one of the more exotic ways that you can exercise stock. And I would never, ever, ever, ever suggest to someone that they should borrow money to exercise private stock options. It is a bad idea. Don't purchase options with money that you can't afford to lose. But there's some other interesting things, like you see like Equity B, and I'm not exactly sure what SecFi does, but there's a whole bunch of these other companies out there that will either like offer things like forward contracts. Forward contracts are kind of an interesting thing, which I've never actually written about, partially because I've never done it, and so I don't know all the specific mechanics of it. Like I know how they work. Basically, like a forward contract is, you sign a contract with someone that says, I'm your, like if I'm the seller of the stock, I am selling my stock to someone else at X price, but I'm not actually selling it right now because I can't sell it. There's no market for it. So the contract basically says, when you're able to sell it, you will give us the proceeds, and we'll give you this money now, basically. So like they're paying you money now for like contractual ownership of stock that you technically still own according to the IRS. So it's like a way to get around, well, I don't know if the IRS considers it like constructive sale, but it definitely helps with taxes, and it definitely helps with just like lack of liquidity, right? Like private markets, some companies don't allow secondary sales. They don't allow employees to sell stocks. Some companies do, but it can be a really long, drawn out process. So like you see those sorts of things, and then cashless exercise is something that I'm hoping more companies will get into, where you basically trade out some of your options to purchase others. And so like you can structure that in a way where I think you could theoretically cover taxes, but you basically sell the stock back to the company in exchange for purchasing the stock cash free or something along those lines. That's a pretty cool maneuver that I haven't seen often. The only time I've really seen it is in tender offers. But anyway,
interesting. But for companies that are I guess going to get acquired, or something happens to them, some sort of liquidity event, I mean, what should people know about liquidation preferences?
Ooh, good question. So liquidation preferences are so there's like different levels of stock. Investors are typically buying preferred stock. Employees, when they get ISOs or NSOs or stock options, when they exercise those options, they are receiving common stock. And sometimes you also see different classes of common stock, like Facebook, Meta very famously had Class B and Class A, and Zuckerberg owned all the Class A stock, and Class A stock had voting rights, Class B stock didn't. So basically, like Zuckerberg controlled everything
For life.
Yeah, for life, benevolent dictator for life. So in the case of investments, preferred stock is typically considered senior to common stock, which means like investors get paid first. And when fundraising rounds happen, there is usually some sort of liquidation preference. If the term sheets are really clean, if it's a good deal for the company, it's just going to be 1x, right? Like they're going to get paid back their money, and then that's, everybody else gets paid after that. But sometimes you'll have situations where they have 2x or 3x liquidation preferences, or liquidation rights, and so they actually get paid 2 times their investment or 3 times their investment before the employees ever get a cent. And so, this gets into this starts to get a little bit wacky once you start talking about the actual mechanics of acquisitions, because there's also this concept of like participating versus non-participating stock. And so, when an acquisition happens, I think the way this typically works, and this might have me a little out over my skis, so if either of you know this more, like, you can correct me if I say something wrong. But like generally, my understanding is that investors sort of have the option of saying, I want to participate in this acquisition, and I just get paid, the same price according to normal. Like I just get paid out along with everybody else, because it's a really good acquisition. Like we all made tons of money, we're happy. And usually, where the liquidation preferences become a problem is if the company, like there's not enough money to pay out the investors according to their liquidation preferences. In those cases, they wouldn't participate in the normal, payout, and they would say, no, I want to get paid my 3x lick preferences before anybody else gets money. And so that actually reduces the overall effective price per share for everybody else that is participating. And so it can get messy. Like what happens in an acquisition can be like really, really contrived.
Oh, it can be. And I've actually seen that happen, which is why I brought it up. It was just, it screwed the employees.
Super gnarly. Yeah. It sucks.
It really does. Because because you from the perspective of an employee, you're taking a bet on this company, right? And it's like putting in my time and opportunity cost in this thing. And not only did I not get anything, but felt like I got swindled in the process.
Yeah,
but them's the breaks.
And this goes back to like that. One of the things I said really early on is like, sometimes companies are really sketchy and like shady and not willing. There's like very skittish about sharing this kind of information. Now, I don't think like, if you're a run of the mill, like individual contributor employee, it's going to be pretty hard for you to go to a company and be like, tell me, like, do any of your investors have like, preferable liquidation preferences? Like, you're probably not going to be able to get that answer easily. But again, I think that, this comes back to like looking for companies that are getting like, good terms. Like the better the terms they're getting, the less likely you're going to see weird, unusual stuff like this. And so like, kind of historically, like an easy way to look for like, is this company probably getting good terms, is like, how much dilution are they taking in a round? And the easy way to calculate that is how much money did they raise and what was the post-money valuation. So when someone says they raised, $100 million at a $1 billion valuation, what they're effectively saying is we sold 10% of the company for, at this valuation. And so, when you start to see things like 30-40% dilution in a round, like that's where I would start to raise my eyebrows. And like, if someone is saying, raising, usually if they're raising at those types of terms, they're not going to say what the valuation was, because it doesn't look good, right? If they raised $100 million and the company is worth 200 million after that round, like that's not great. And that's where I would start to see, like, I would start to expect to see some of these kind of weirder, less clean terms on a term sheet.
Yeah, because at that point, the investors are basically like, preferred stock is almost like a form of debt. And so they're basically loaning you money, saying, here's some money, maybe you can keep going. But if not, we might be liquidating in a year, and then we get paid back first. Everyone else is good luck.
Yeah. I don't know if I would think of it as debt, but it's definitely like, but yeah, I agree with the what you're saying in principle.
So, what are your thoughts? I guess over the next year or two, rates kind of rise, inflation gets back to whatever normal happens to be in this weird 2020s. What do you think happens to startups? So do you think we're going to kind of see the pandemonium we've had over the last couple of years, where everyone's doing a startup, or or do you think things are going to be a bit more sane and people are going to kind of grow a bit more slowly? Do you have any thoughts on kind of zooming out?
I mean, the sky doesn't seem to be falling right now. Things could change, right? Like, there's not only like inflation and those sorts of macro issues, but like the Ukraine war is still going on, and that's still going to have impacts on supply chains and food shortages and things like that. And there's just all sorts of stuff that could like still create dynamics where sorry, all hell breaks loose. But from my vantage point, it sort of feels like it's just going to be, this is going to be not a short thing. We're not going to see like a pandemic type of recovery where things go down and then shoot back up. Like, this is going to be much more like low and slow. And I think we'll see. I think things are going to start feeling a little bit more dire in like 12 months, because that's when a lot of companies that just raised are going to start needing money again, or they're going to need to go looking for funding. And so like right now, things are just quieting down because everybody who doesn't need money is just like, well, I'm not going to raise right now. I'm just going to like extend my runway and keep going. But eventually companies are going to get desperate. And the companies that aren't, improving their unit economics and improving their kind of situation, those are the ones that are going to get penalized really hard. Those are the ones who, are going to be laying people off in droves. Those are the ones who are going to be raising pretty, stunning down rounds. And those are the companies that'll be getting acquired, for pennies on the dollar, right? Like that's what I expect to see. But I think that there's also going to be winners, right? There's going to be winners and losers. So like,
DBT is one of them for sure.
Yeah, I think I say it both in part because I am a hiring manager and everybody should join DBT, but also because I truly believe it. Like there's a reason I'm here, and I don't I work places because I think that it's going to be good career growth for me, but also because there's going to be a financial payout for me at the end too.
Yeah, you guys are killing it, seriously. So
fingers crossed, it's going well for now.
That's awesome. Cool. Coming up on time. Thanks for being on the show. Great chat. For people who want to learn more about you, how would they do that?
You should go to my Substack. It's semistructured.substack.com. That's where I write about stuff. Sometimes I write about data things, but I feel more self-conscious when I put those things out there. I'm also, if you go to the DBT Slack, you can find me. I'm at Natty, or Twitter at Natty Ice. I don't.
That's amazing.
I've had it for a while.
That's so funny, man.
Has Natty Ice tried to sue you to get their Twitter handle back?
No, nobody's ever. I get weird ats sometimes. Like sometimes I get weird mentions. But
can't imagine why.
Yeah,
a lot of mentions from like UC Santa Barbara, Arizona State for some reason.
Every now and again, things like that. But all those places. But if you're interested in equity stuff or DBT, like definitely hit me up on the DBT Slack. I love chatting with users and customers alike.
Cool. Awesome chat. Hopefully the audience didn't get any questions, which is kind of surprising. But I guess it's how it is. But yeah, hopefully the audience found this useful.
Hopefully it was engaging.
I mean, we had a lot of people on the LinkedIn, especially. Cool. So I mean, there's
awesome.
Yeah, for sure. And if you really want to make your future bright, you should buy the Fundamentals of Data Engineering from.
I second that. I concur.
Yeah. So this book will it's almost the same thing as Startup Equity. It'll change your life. It'll change your fortunes. And if you don't buy it, you might be really poor. Your life might just crumble into ruins. So I would suggest, doing the right thing. Get the book.
You might be drinking Natty Ice.
Might be drinking
like some really high class yet.
Yeah, exactly. I mean,
I'm actually a beer snob. I never drink Natty Ice.
Do you have a particular flavor of Natty Ice? I'm just joking. That you like, or
never ever.
No, it's a remarkably bad drink. I'm not even gonna dare call it a beer. It's just,
I've never had it.
You haven't?
Life. No.
Well,
yeah, just skip it. It's not worth it.
That's hilarious. Well, yeah, for the audience out there, enjoy a Natty Ice on your weekend. Enjoy the book, enjoy Natty Substack. It's actually really good. You should definitely subscribe to it. check it out. He's got some great articles on it. I think I read most of them actually, and so yeah, they're great. So because I like it, you should like it too. Therefore, go subscribe, smash the like button. On the Monday morning data chat coming up, we got Addie Pollack. We can talk about all things big data, data engineering, data lakes, whatever she wants to talk about. She's cool.
That's going to be kind of an O'Reilly authors podcast.
Actually, it is.
Right?
Yeah,
we want to do more of those, but yeah, it should be fun.
that'd be a lot of fun. And if you're in Utah Data Engineering Meetup on the 20th, I think it's on a Wednesday, third Wednesday of the month. Matt and I are going to be talking about, let me see, our book, so you should definitely come check that out. But anyway, yeah, fun times. Cool, Nat. Have a good weekend. Hope to see your next posts.
Yeah,
look forward to it.
So,
when they're coming.
Yeah, keep up the great work. All right. Thanks to the audience. Have a great weekend. See you guys.
For the time.
Bye.